Okay, let's dive right into this explainer. Today, I'm going to actually step in and act as your personal financial mentor. We're looking at a complete blueprint, one specifically designed to help you navigate your long-term success right through the middle of all this current market noise. If you're just starting your financial journey, or maybe you're a young professional just trying to figure out how to build wealth without losing sleep every night, you are in the exact right place.
So let's get into it. The last 6 weeks, they've honestly felt like Wall Street just stepped on a massive trampoline. I mean, major US stocks have jumped more than 20% in barely a dozen trading sessions. And look, I know when you see a violent upward move like that, it's incredibly easy to feel this sudden, massive fear of missing out. You start wondering, wait, is it too late? Did I literally just miss the boat?
To answer that, we really have to look at history. Rallies this powerful, they are exceptionally rare. If you pull the data all the way back to the 1960s, you'll only see a handful of instances that match today's specific combination of a violent recovery, cautious public sentiment, and upward-sloping earnings. But here's the real secret. History shows us that these rare, once-in-a-generation surges usually mark the start of incredibly long runs that make patient investors very, very happy. Honestly, the bigger move is just getting warmed up.
Yet, despite those historical facts, almost 50% of everyday Americans still believe prices are going to crash within the next 6 months. They are totally paralyzed by anxiety. And hey, it's completely understandable. You open your news feed, and what do you see? Recession chatter, sticky inflation, political fights over debt. It literally feels like climbing a wall of fear. But taking a step back and removing a brick from that panic wall, that clears the way to finally see what's actually driving things.
Which brings us to Section 1, Why Corporate Earnings Drive Growth. So while everyone was busy arguing on TV about a macroeconomic slowdown, this very small group of massive companies quietly went ahead and absolutely smashed profit records. Think about this. The 8 largest companies alone now generate a full 25%, a quarter of the entire index's earnings. That's massive. Even if their incredible earnings growth cuts in half, the sheer mountain of cash they spin off completely justifies today's sturdy market valuations. There is a stark contrast between television pundits and actual corporate reality. While the talking heads are out there debating doom and gloom, sectors like semiconductors and cloud computing are printing numbers that look way more like early-stage startup growth than, mature company bookkeeping. We're talking about projected double-digit earnings per share growth for 2025. Share prices have really just caught up to this reality now that fear has kind of loosened its grip. And this underlying strength is exactly why the broader panic is fading. Back in early April, futures markets were pricing the odds of a US contraction near 70%. That's huge. But since then, thanks to revised GDP data, really stable jobless claims, and a surprisingly resilient services sector, that risk has been slashed to below 40%. Basically, as long as the country keeps growing, corporate profits, and by extension stock indexes, usually just keep grinding higher.
All right, moving on to Section 2, the 3-layer investment strategy.
Now, high-altitude markets can drop suddenly, so blindly chasing momentum, that's a recipe for regret. Instead, I want to teach you a really simple, totally stress-free blueprint to build your wealth foundation. We start right here with Layer 1, the foundation. This should be a broad, low-cost index fund that captures the entire market. By owning the whole basket, you inherently lower your stress. If volatility swings again, and it will, you don't panic. Why? Because you're making small, automated weekly or biweekly purchases that naturally smooth out the ride. This is the bedrock of your entire portfolio.
Once your foundation is totally set, we add in Layer 2, Targeted Sector ETFs. This is where you get targeted exposure to the really exciting themes driving the current surge. We're talking semiconductors, cloud computing, AI tools, and essential infrastructure. But notice something important here. We're using exchange-traded funds, ETFs, not picking individual stocks. Breakthrough tech can whip up massive price storms on rumors alone. So selecting ETFs spreads your risk across dozens of firms. It perfectly protects your portfolio from those unexpected single-stock shocks.
Let's move right into Section 3, Layer 3, and Mastering Your Emotions.
Now this next part, this is absolutely the most critical piece of the whole puzzle. I want you to burn this into your memory. Panic never schedules an appointment. It just shows up. Markets could tumble tomorrow on some random news no analyst ever sees coming. That risk literally never disappears. What you actually control is your time in the market. Every single correction of 10% or more eventually gives way to fresh highs. The bigger the slide, the bigger the rebound. That is, if you maintain your discipline and fight the urge to sell into the panic.
And that perfectly brings us to Layer 3, the cash reserve. Think of this as your dry powder. It's your opportunity jar, just sitting there waiting patiently for the next bout of fear. This layer is absolutely vital, guys. When headlines inevitably turn red and scary, holding this third layer of cash ensures you're acting from a position of absolute strength rather than just wishful thinking.
So why is that cash so incredibly vital? Because of this massive 20% discount. Let's look back at the spring spike. The volatility index kissed 30 and panic was literally everywhere. But anyone who had that layer 3 dry powder sitting quietly on the sidelines, they were able to step in and buy incredibly high-quality companies at 20% discounts in a matter of hours. Having cash gives you the superpower to buy when everyone else is absolutely terrified.
All right, let's bring it all together in Section 4, your action plan today.
Now that we know the environment and the strategy, let's look at the actual math to lock in your financial future. Because trust me, none of this requires day trading skills or a fancy finance degree. Let's suppose you move just $50 a week, which is roughly the cost of maybe 2 streaming subscriptions, into your Layer 1 index fund. Over 10 years, your total out-of-pocket contributions would be $26,000. It's a completely low-stress habit, using money most people spend on things they barely even notice.
Now, assuming a historical average return of 8%, compounding would lift that $26,000 in contributions well north of $38,000. And hey, if the economy enjoys a robust cycle like the ones following similar historical rallies, those returns could run even higher. Add in your Layer 3 lump sum buys during those scary market dips we talked about, and that growth curve bends even steeper. Your patience and automation are quite literally doing all the heavy lifting for you. But before you fully embrace this market's gift, as your mentor, I really need you to check off these 3 final rules. First off, eliminate expensive short-term debt. Paying 20% interest on a credit card while hoping for an 8% market return is just running in place. You gotta cut it out. Second, build a basic emergency fund. You never want to jeopardize your rent or groceries when you invest. And third, automate those contributions. Set it up so your discipline doesn't rely on your day-to-day willpower.
If you take a quiet moment tonight, open up your brokerage app, schedule that weekly transfer, and pick your broad foundation fund alongside your targeted sector fund, you are choosing a really rare path. In a world where everyone is chasing instant thrills, you are choosing to own assets that work harder than you do. And honestly, when you do that, all those future volatile, scary headlines just become background noise.
Years down the road, when your friends look at you and say, "Man, I wish I'd invested back when prices were still reasonable," you'll be able to just smile. Because you understood that an opportunity like this might never come again. The whole narrative could shift again in 6 weeks. So I'm going to leave you with this final thought to ponder. The window is rare, the clock is ticking, and opportunity is definitely knocking. So, will you answer?